Good evening, everyone. Now, welcome to our East Malaysia CPO webinar series. This webinar series is brought to you by Bursa Malaysia Derivative. Our topic for today is Trade to Win in FCPO and FEPO. Now, our session for today, we are going to divide into two different sessions. The first 60 minutes, we are going to be presented by both our speaker, Jeremy Kwa, and also Michael Sim. And the final 30 minutes, we are going to have a Q&A session and also quiz. Now, before we start, my name is Ting Ting. I'm the moderator for this session. Now, as usual, please make sure that you can hear us. You can see our slides. If you can hear me and also see my slides, can you please type in the chat box, yes, or you just click on the emoticon. I repeat, if you can hear my voice and you can see my slides, can you please type in the chat box, yes, or you can click on the emoticon. Great, very good. So it seems like you are ready to go. Now, as usual, please make sure that you turn off your video so that you have a better quality session. And along the way, if you have any question, while our presenter, they are presenting, at any time, you can just click on our Q&A box and type in your question. Subsequently, please select send to all co-hosts. I repeat, if along the way while our presenter, they are presenting, if you have any question, you can at any point in time, just click on the Q&A box and type in your question. Please do not type in your question in the chat box because we might not able to pick it up. So I repeat, please do not type in your question in the chat box as we might not able to pick it up. So just click at the Q&A box and send in to all co-hosts. Now, as you're aware, besides today's session and also last week's session, upcoming this Wednesday, we are going to have another topic, how to diversify your portfolio with commodity futures. This particular webinar session is a crossover between Chicago Mercantile Exchange, which is CME, and also Bursa Malaysia Derivative, which is BMD. So for registration, you can see that the link is on your screen, or else you can scan the QR code and you can register accordingly. Now, I'm not quite sure whether you're aware or not. As usual, for this FEPO webinar series, we are going to have a lucky draw session. So the previous lucky draw session, we have all the winners, they already claimed their gift. So upcoming for today's session, as usual, we are going to give away 5 Touch and Go e-wallet reload pin, each worth Ringgit Malaysia 100. So how can you win this or become the lucky winner? Now, you just need to stay with us and make sure that you pay attention while our presenter are presenting. Now, let me introduce our first speaker for today, Jeremy Kwa. He's the representative from Bursa Malaysia Derivative, and he's currently the manager of the intermediaries team. He has been tasked in bringing in high volume traders and individual professional traders to trade on the Malaysian derivative market. So without further ado, let me pass it over to you, Jeremy.
Okay, before I start, just a quick introduction. My name is Jeremy. Thank you for the opportunity for bringing me representing BMD for this presentation. So without further ado, let's move to our today's agenda, East Malaysia crude palm oil. So before I start, just a quick overview on our Bursa Malaysia derivative Berhad. So BMD, I will put it in short form. BMD is actually a subsidiary of Bursa Malaysia, which is actually established in 1993. So for BMD itself, we do offer the commodities and financial derivative products. And of course, with our star product itself, the FCPO is actually the global benchmark for the pricing of crude palm oil itself. So for your knowledge, BMD products are actually traded or matched on the CME Globex itself. So CME is actually a matching engine which provide easy access and connectivity to the global market participants. Next. So the slide before. So this is just a quick snapshots on the BMD. What are we offering? So we got, as you can see on the screen itself, so CPO and FKLI is actually our star products. And on the 4th of October itself, we also just launched a new contract, which is called, which is today main agenda, which what we call East Malaysian CPO futures, short form as FEPO. So further down, I will just explain why are we doing this kind of, why are we creating this contract, you know, and some of the reason itself. So just for your knowledge, what is FEPO? So FEPO is very similar to what we have for FCPO, the crude palm oil itself. So some of the basic knowledge that you need to know is, you know, FEPO is actually denominated in Ringgit Malaysia. Okay, and then it was traded on BMD itself, and it's actually an avenue for you to for price discovery crude palm oil in East Malaysia. So for the contract size and all the settlement and maturity delivery parts are very similar. So for each contract size of FEPO contract is 25 metric tons of crude palm oil, and then the settlement itself is physical delivery, and then the maturity of every contract is 15 day of the spot month itself. So the delivery part, that will be a slightly different. So I will go on to the next slide. Okay, before I go on to the difference, this is actually some part of the reason that why are we creating this contract. So as you can see on the top left-hand side of the slides, you are looking at two pie chart itself. The first pie chart, it actually said that in year 1995, in East Malaysia, the productions of East Malaysia is only 22%. Right, while Peninsula actually make most of the palm oil itself is actually at 78%. But fast forward to 25 years, like last year itself, as you can see, what is the production? The productions actually increased from 22% to 45%, while Peninsula Malaysia is actually kind of like, you know, slow it down, and it actually stays at 55%. All right. So now let's move on to the next, to the top right-hand side of the slide. So this actually shows that this is the exports of the palm-related products between 2011 and 2020. So what does this graph actually shows? So since 2013, right, the export of the palm-related product by East Malaysia is actually surpassed that from Peninsula Malaysia. So in 2020, what you can see here is East Malaysia exported 8.8 million tons of palm-related products, comparing to like Peninsula Malaysia, it's only 8.4 million tons. Okay, and then this amounts to like, you know, the total value of the export value is approximately like 49 billion. Okay, so what you can see on the bottom of the graph itself is the spread price between Peninsula and East Malaysia. So this is actually what is the discount price or the premium price in between these two sites. So from year 2016 to 2020, the average of the spread price itself is actually 46 ringgit and 40 cents. So, but it actually maximum actually went up to 132 ringgit. Okay, but on average itself is actually 46 ringgit and 40 cent. Okay, so all of these source that you are looking at these slides, you actually regarded from this MPOB, the Malaysia Palm Oil Board. Okay, so another reason is like, as you know, our East Malaysia, the land is much more bigger, you know, and a lot of palm oil. So this is actually one of the planted areas that you are looking at is, you know, Sabah is actually got 1.543 million hectares, and matured is actually 1.345. So it's 87% use, and immature is 13% only. While for Sarawak itself is 1.585, and they are utilized at actually 90%, and immature is actually 10% itself. So for CPO productions, what you can see here is Sabah is slightly higher than Sarawak. So on a yearly itself is actually 4.65 million metric ton, while for Sarawak itself is actually 4.05. Okay. So move on. These are some of the key differences in terms of FEPO and FCPO itself. So the main difference is actually from the trading hours. So the first thing first is FEPO actually starts earlier. So it's actually start from 9 to 12:30 p.m. And then we got approximately like 2 hours break. So we're gonna start the second sessions on 2:30 p.m. and then until 6 p.m. itself. For FCPO, it's gonna start later a bit. It's gonna start at 10:30 a.m. and then until 12:30. Take a short break itself. Then 2:30 to 6 p.m. Okay, so this is the port of delivery where the physical settlement kicks in. So this is the port of delivery is for FEPO itself is actually from Lahad Datu, and then the second one is gonna be at Sandakan and Bintulu. While on the other hand, for FCPO is Port Klang, Pasir Gudang, and Butterworth. So for precision limits, as you can see, what is the differences in between FCPO and FEPO is the numbers is slightly smaller for FEPO. It's due to it's kind of like a new contract itself. So that's why we're set at a smaller position limit for people to hold. So 800 contracts for the spot month, 10,000 contracts for any contract month except for spot month, and 15,000 total contracts combined, all months combined. This is for FEPO, while for FCPO is 1,005 contract for spot month, 20,000 for any one contract except for spot month, and then 30,000 for all months combined. Yeah. Next, please. So this is what you can see here on the graph. This is the trading performance on the chart itself. So what you can see here, there's the volume is not high, but there is some volumes traded for the past October, November itself. Okay, and then apart from that, we also do have an open interest for this product. So I would say that this products is actually doing quite well at the moment. And then we also do have a few incentive and margin for you guys if you guys are interested to trade. So we got this 3-for-1 waiver for every 3 lots of FEPO traded. There will be 1 FCPO waiver for exchange and clearing fees. So meaning to say that you trade 3 lots of FEPO, you get 1 free of FCPO. Then apart from that, we also do have this FCPO and FEPO intercontract spreads credit. We got 70%. So what does it mean is, let's say if you are trading a spread contract, for example, you buy 1 FCPO and you have 1 short of FEPO itself. The margin requirement is only like 30% of each contract. So for example, the total like 1 FEPO is 5,000. And then for FCPO is 6,000, so you need 11,000 for these 2 contracts. But if you are trading this spread itself, if you add it up with the 70% reductions, then it will cost you approximately like 3,500 or 3,600. Okay, then and again, FEPO margin is kind of slightly cheaper than the amount is kind of smaller, not to say cheaper, but the amount is smaller comparing to FCPO. So FCPO is 6,000 and FEPO itself is actually 5,000. Okay. So the next slides that I would like to present is not much on a FEPO itself, but it's just to let you know that we do have this virtual trading simulator, which what we call derivative trading simulator. So if you're kind of new in derivative market and if you would like to kind of like put your hands wet and try to feel the market movement itself, you may go to this website on www.bursamarketplace.com/mkt/DTS. These simulators which provide you a real-time market data, which means that every second market move, it moves. Okay, and then you are able to place. You will be given a virtual margin as well, 100,000 for you to try out your strategies, and then of course comes with charting tools, and you are able to customize your orders and positions monitoring, and then we do have a price ladder and quotes monitoring as well. Okay. Next slide, please. So other than that, you may go to our bursamarketplace.com, the homepage itself. This is actually just to guide you to how to look at the simulator. Okay, so I think that's pretty much for my slides. So to summarize the whole DTS thing, So first thing first is you access to DTS microsite at Bursa Marketplace. All right, then you click Start Now, and then you complete the forms to subscribe. So once you subscribe for this DTS, right, you will have a 30 days of access to this simulator itself. Okay, so if you have any further inquiries, right, please feel free to reach out via futures@bursamalaysia.com. Okay, all right, that's pretty much sums up my presentations. Thank you.
Our second speaker, he is very experienced. Now, his name is Michael Sim. Michael Sim is a director and co-founder of Inspirante Trading Solution. His career spans an extended period from the era of exchange floor trading to today's electronic trading. He has more than 20 years under his belt and experience in both the sell and buy sides of the business from his years with Merrill Lynch. Michael possesses extensive knowledge of market microstructure across a broad spectrum of products with a specific focus on index valuation and also spread trading. So, Michael, are you ready?
Yes, I am, Ting Ting. Thanks for the kind intro. Should I take over now?
Yes, please go ahead.
Okay, right. Thanks. Well, first of all, I'd like to thank Bursa for giving me this opportunity to speak with you guys tonight, and for excellent Ting Ting especially for organizing this event. Now, my name is Michael Sim. Thanks for the kind intro earlier, Ting Ting, and I will just dive right in. All right. Tonight's trading topic obviously is in FCPO and FEPO, and I will try to present a trading view, a strategy, some strategies that I've been using, and hopefully it will benefit you as much as it did me. All right. Now, before I go on to the materials, I'd like to just bring your attention to this disclaimer. All right, given the nature of what we will be presenting tonight, you need to understand the information in this presentation have been obtained from public sources, which we believe are reliable, and no reason to believe is not. And any forecast analysis or projection is purely that opinion of mine. And if you should not be relying on this on the basis of this presentation itself as a trading decision maker for any trading decision, you would be wise to still obviously consult your trading advisor, your future brokers, and whatnot. All right. Okay, moving on. Ting Ting has already done a very extensive introduction of myself, so I'm not going to bore you with the same thing. Just know that I am still currently trading. In fact, I've been trading for the last 15 years or so actively, almost every other day except when the market is closed. Well, practically the market don't close these days, so very much every day then. Okay, now for tonight's agenda, I'm going to just talk a little bit about Inspirante Trading Solution, short for ITS, which is really an offspring of SLC, the firm for which I've been trading for the past years. And then I'm going to go on to share a little bit of our trading philosophy and my take on how we should approach trading itself professionally. And I hope that benefits you at the very least in your approach to how you see trading as a business venture. All right, then we'll go on to what we do. Come here for tonight. I'll start with an overview of FEPO and FCPO for the matter. And then we'll go on to some trading strategies that I think is doable. And I've been doing it actually. So let's go on with that before we end with Q&A, all right? Okay, a little background about my company. SLC is actually a proprietary trading firm. We engage in exchange-listed derivatives trading mostly. And we started back in 2011 when the floor, actually last time there was a futures trading floor in Singapore called CIMEX. Now it was eventually shut down because of the arrival of the electronic platform. And that's where we actually, a lot of the ex-local was trading on the floor physically. They came together and they found SLC. And I was fortunate to join them back in 2015. So I mean, times have been good and fast, and I've learned a lot through the course of those years, as much as I have on my previous job with Merrill Lynch and other banks. Okay, now back in 2020, we actually started Inspirante Trading Solution (ITS), which is really our effort or our initiative to focus in our educational initiative in this area. Now, what we realize is actually in the market, although there are a lot of trading courses and whatnot, there are a lot of instances where it does not come to fruition in terms of the end of it, the conversion of actual cost to skills that is usable in the trading arena. So we wanted to do something about it, and that's why we started ITS. On top of training courses, we do other stuff as well. For example, we regularly conduct webinar in collaboration with the exchanges, with the brokers themselves. These are some of those that we've done previously in various topics, and we also conduct physical class. Now, one unique feature of our class is actually there is, on top of the classroom presentation, there is an area where we actually do mentoring. Basically, for lack of better description, is we have a bunch of traders, our team of traders standing behind the participants, for example, the students, and guide them while they physically trade in a simulated environment using real-world trading data. We thought that is actually extremely helpful to some of our students. And the actual fact is, I'm glad to tell you, a lot of our participants actually did very well. I mean, of course, it will take a while for them to gel in, but generally speaking, they were doing fairly well after the classes. Okay. We also do regular write-up for the exchanges in CME in this case. This is a bi-weekly write-up by one of my colleagues called Fresh from the Trading Room. If you're interested, the link is there. You can have a look at it. It generally talks about our trading idea, our thoughts, our view of the market, and we try to present certain tradable ideas that you can actually look at and probably model or just tag on the idea of what you want to do actually. Okay, now a little bit about how I approach trading. I've been trading for so long actually, I didn't even think about it. I have a lot of fun in trading, I got to tell you. Of course, it's frustrating at times. Okay, so you need to have a clear goal in the sense. For myself, other than the obvious, which is wealth and personal growth, all right, I need to have a sense that I want to do it for a long haul. So the viability is the part that comes in. I need to have a way, a plan to ensure that I can do this for a sustainable period and make sense to me. I mean, I can't be losing money day in, day out and still be trading after 10 years. That would be ridiculous, right? So the whole point of this is eventually to get to the point of independence, doing what I'm doing. So I have a greater degree, not just financially, as personal freedom as well, and as to how I arrange my time, for example, with my family and stuff and other important stuff in life. Okay. Now, when it comes down to trading, there are really only three things that I think about. Okay. The first and foremost is preservation of capital. In a way, what I'm trying to do or trying to say here is no matter how I trade or when I trade, my first concern is whether I will be able to trade after I put in a particular trade at this point of time. Okay. So now then what it means is really when I'm taking a trade, the risk will be the number one concern here. Okay. I do not want to be wiped out for a chance of getting a tremendous return. I mean, the risk is simply not worthwhile no matter what the return you look at. All right. So the first and foremost principle that's guiding me all these years and managed to keep me in the game is basically the preservation of capital consideration. All right. You got to ask yourself whether when you put up a trade and if it went against you, are you able to get out without hurting yourself so much that you'll be out of the game tomorrow? All right. That's number one consideration. All right. And beyond that, the second thing I would think about is the consistency of profitability. Then obviously, I want to be profitable on every trade. Now, that is not possible in trading, as I'm sure you're aware. So the existence of a plan, objective and structured way of going about trading is what will ensure that I have certain consistency in what I'm doing and will keep me in this game for the long haul. And finally, beyond that, if you take care of number one and number two, number three is fairly obvious when the chance and the opportunity present itself, for example, and that's where you can actually go after the superior returns. Now, using this as the guiding principle is how I approach trading, and I hope you can see this in the same light as me, because in essence, we approach trading professionally like a business. Okay, when you have a business, you want to consider running it for the long run and you're not just running it for one day and then shut it down the next. So that's our primary concern. And how to do it, you need to have a plan and you need to be able to identify opportunity when it presents itself after you take care of the first two considerations. Okay. And in essence, when we talk about risk management, I'm sure you guys are quite familiar, but to sum it up, it's all about capital and position sizing. I mean, futures is a leverage instrument, all right? Some going up to 20 times leverage, for example. So leverage is a double-edged sword, okay? It can work for you and it can work against you. So the paramount number one consideration for me is what size of capital are you committing? Like, or you can afford to commit. And therefore, from there, you derive your position that you can trade without hurting yourself in a sense. Now, in the most general way, my rule is usually I will not risk more than 5% of my risk capital on any one position or any one trade. Okay. So if in the event that it doesn't turn out the way that I expected to, at least I have a way out and I'll have the other 95% to fall back on to bring me across another day in a sense. All right. And obviously the second point is like what we mentioned earlier, the trade plan. A trade plan is something like you come up with not from mid-air. You have to do your due diligence, your studies, through your experience, you formulate certain way and by way I mean objective way. You cannot second guess yourself every day when you're trading. That is the worst thing you can do to yourself. All right. And you have a plan like what is your entry, what's the entry rule, what is the exit rule, for example, you stop losses and stuff like that, and you keep to it, all right, on a consistent and repeatable basis. All right. And most importantly, like I said, the third point is the discipline to follow on with your plan. Because the best plan in the world is going to mean nothing if you don't have the discipline to follow through with it. Okay. Now that is actually the most difficult thing to do for most traders that I know. Okay, it's not for the lack of a plan, for the lack of knowledge, but rather the discipline to follow it when times are tough. And that's absolutely one of the most important thing you need to tell yourself to be able to do. All right. And finally, before I leave this, just understand risk management in trading is never an option. All right. It must be your number one consideration. Okay. Right. So now let's go to an overview of BNB CPO futures. I say CPO futures because right here we're going to talk about FEPO, but I like to mirror a lot of things from SCPO. So in general sense, the CPO futures complex is pretty much the same commodity that we are talking about. So I like to present an overview in that sense. All right. So now, like every other commodity, right? Palm oil are subjected to the dynamics of demand and supply. Okay, the supply being the production, the stock level, and imports and whatnot, for example. And Jeremy did a good summary earlier. I mean, it depends on plantation land, it depends on season, it depends on weather, and availability of labor, for example, to do the harvesting and therefore affects the production. All right. And the demand side obviously is the user, be it industrial user, end user, for example. And one of the biggest users, obviously, for palm oil is in the edible oil complex. Okay, it's roughly, right now, I think it's about 80% of the world's edible oil consumption comes from palm oil now. Okay, now the other crucial and usually interesting element in this fundamental drivers is that of the substitute. Being an edible oil, there are a lot of possible substitute, the like of bean oil, for example, soybean oil, rapeseed oil, sunflower oil. All right, all these are actually in a way interchangeable with crude palm oil for the edible in the edible complex, for example. Now, why is it important that we know what is happening in all these things? Because any changes in all this, any one of this or all of these factors will have a direct impact on the prices of CPO. And we need a understanding. You don't need a deep understanding. Now, the fact is you probably cannot know everything there is to know about this because you are likely to be the first-hand information receiver in that sense. The institution guys probably beat us to it in any way. But you need to get a sense of this. So you get a gauge of the settlement. Of course, the price will tell you something, but you need to know, at least understand through your course of understanding and studying this market, what drives the market, what drives the price. And all these are important things that you should pay attention to. Now, where can you get all this information? There are a lot of sources. MPOB is one very good website where you can get a lot of this information. I will show you what I normally do. Okay, for example, I will gather the production numbers, okay, in CPO. I put in East and West Malaysia, basically in this case. And over the years, in terms of monthly production numbers, now as you can see, one dominant feature that stands out is the very consistent reduction in production level in the past almost 2 years now, since we're at the end of 21. All right. I mean, COVID is one thing. Obviously, that led to labor shortage, low inventory, and other things, right? So I keep track of this one, for example, to get a sense of what is pressuring the market right now. Okay. The next thing, obviously, you look at inventory. Again, the same picture roughly. The numbers plus minus basically depicts the month-over-month increase or decrease. And obviously, you can see it's been a long while since we're in the red. I mean, the inventory level has been going down drastically compared to what was the average of like 1.4, 1.5 million tons at times over the 3 years ago. All right. So that is actually keeping upward pressure on the price as well. So this kind of thing you can actually do, just do your due diligence, add in and sense actually for yourself if there's any changes and what's to come, to get a better idea of what's moved the market and possibly where it's heading in the near future. And obviously export, which represent demand, is the same thing. It's also another thing you want to look at, which is the other side of the equation. And all this number, again, can be had from MPOB, apart from a few other sources, like Oil World, for example, and a few other commercial data collectors. Actually, they actually do a subscription service that you can get all these numbers conveniently if you are interested, right? Okay, so this again is the inventory numbers over the last 3 years, 3 or 4 years, basically. As you can see, the orange line, we're on the low side of the inventory level for the past couple of years. There's no surprises there. I mean, obviously, it's not a straight line because of seasonality in the market, which I'll explain a little bit later. And what had happened then? Well, I mean, you're familiar with the fact that the CPO has been on a huge rally since almost late 2020, and we are almost at we are actually at the historical high right now. And CPO is not the only oil that goes up. All right, we got the bean oil, the other edible oil complex elements are also going up in a substantial manner. And you could actually discern from the earlier data, for example, that this is bound to happen given reduced production, reduced inventory level, and increased demand. So it's a simple matter of detailing and understanding how the dynamics work in that sense. Okay, so my take of this is actually there are a few forecasts that the pump is still is likely to continue its firmness in this price, because we're nearing the end for one thing, which is usually a seasonal high demand from the Indian side, and plus the production is not exactly at its peak right now. But we are hopeful that eventually, with the return and the easing up of measures, for example, the labor returning, we'll be able to catch up on production and eventually inventory. Now, some forecast is probably by second quarter next year to see some easing up in the prices due to increase in inventory and stuff and whatnot. So let's just see what happens. Yeah. Okay, then. How do we trade this CPO futures? Jeremy did a summary of the likes and dislikes of the two contract, right? So you guys are mostly familiar with CPO, FCPO, the West Malaysia crude palm oil. Let's call it FCPO. When you compare to FEPO, the new contract, East Malaysia palm crude oil, you will notice as the two have very similar product profile. Okay, what I mean is, like earlier Jeremy already explained, you basically got the same contract specification, 25 metric ton, denominated in ringgit, 25 ringgit per tick. The only differing thing is the trading hours, EPO being slightly earlier. There's a reason for that, which I can elaborate later. They have the same expiration, they lease the same month. It's pretty much the same thing, except in difference in terms of locality, and PTI is the port of delivery for the physical settlement eventually. Now, given that they are same commodity essentially, they are subjected to the same dynamic in demand and supply side forces. Okay, and especially given the proximity of the locality, both are in this side of equatorial belt, it is pretty much subjected to the same weather in a sense. I mean, obviously there are slight difference in terms of factor causes in the otherwise, but that will reflect in the prices itself. But otherwise, the demand and supply dynamics are pretty much similar. I mean, locality, weather, and whatnot is rather similar in that distance. Yeah. Okay. Now, on these 2 points alone, I am going to propose, basically, given the similar product profile, I'm going to suggest a trading approach that actually uses this fact. And I will think a lot of things that you are used to seeing in FCPO will probably be seeing it in FEPO very soon. Okay. Now, to start with, I'm going to do a spread trade proposal, spread or pair trading. What it is basically simply where you have a long and a short position simultaneously put paired together in a sense. Okay. Now the long and short of it can be in similar products. For example, in CPO calendar spread, it is basically the same product but in different expiration. Say for example, if you're long a January and you are short a February CPO, so you essentially long Jan, short Feb. And in commodity, the front month is the dictating part where we talk about buying stuff. So if you're long January, you're buying the spread. You buy the Jan, February spread. So in the sense, so you're long one, short one. In that sense, similar product. You can also do it in a different product. For example, you can do a long soybean futures against a short CPO futures. That is a intercommodity spread. It has its own relationship. I'll explain later, but that is doable as well. Okay, or you can do totally different product as well if you like to, but I'm not going to expand on that. All right, they can be either from this same product arena, same exchange, or different exchange for that matter. Okay, the important thing is we have a long and short here. Okay, and how we approach this is basically looking at two important measurements, statistical measurements for the pairing. Okay, the first one is called correlation, which I'm sure some of you are familiar. If not, it's an easy lookup on the web. You can just take a look at it. And basically, it describes a relationship, if there is one, all right, between two or more products. But let's keep things simple and stick to two products. Say, for example, if I run a correlation test between FCPO and FEPO, I can be almost certain it's going to be a very high number. What it means is both products, given that they are similar, they are expected to, and they should, and they have been trading in a very similar fashion in price sense. Okay, so now the correlation can be obviously positive. Like if I take FCPO and FEPO, when FCPO goes up, I do expect FEPO to go up in a way. So that is a positive relationship, and vice versa if it were to move down. All right, and it could also be negative. For example, if I was doing I'll use an index example. If I was like, for example, doing a Nikkei, for example, which is Japanese index, against a Japanese yen. Now, a weaker yen, generally speaking, favors the Nikkei index. So when the yen weakens, you would expect the Nikkei index to go up. In this case, in this kind of relationship, we have a negative correlation. And versus another one, obviously, it can also be an instant where there are no relationship at all and one move independently of the other. Okay, so when we pair up any product for that matter, the correlation is the number one consideration, that we must ensure that there are some existence of some relationship. Otherwise, there's no way of trading with certainty, or not with certainty, or surety of how we are going to trade this relationship. If there's no relationship, you can't trade it. Okay, and a further measure of that kind of relationship is co-integration. You see, correlation doesn't mean causation. I'll try to give you an example. I'm sure you guys remember how the liquidity have brought on to a equity market spectacle. Let's take US market, for example. Now, it's been running up for the longest time, but not all the indices run in the same magnitude. If you have taken the position, let's say if you have bought S&P, which is really a very broad stock market index representation, and you short the NASDAQ, which had a smaller focus on the tech-heavy type company, okay, you will be losing money basically. Although both indices have been going up since the easing of monetary policy, right? The NASDAQ index has gone up so much more in multiples of S&P. So imagine if you were short S&P, if you were long S&P and you were short NASDAQ, for example, you'll be in a losing money position, because the rally in S&P doesn't guarantee a rally in NASDAQ and vice versa. So it's not a causation kind of thing, which is why we look at co-integration. which is really a measurement of tightness of the pair's move. Now, once you get these two sorted out, you can have a firmer idea of how a pair or product should behave vis-a-vis one another. Okay, on that premise, I propose spread trading for a start, especially given FEPO is a relatively new product. All right. So why do we want to do spread trading? Now, spread trading have a few advantages, obviously. First of all, it lowers the risk considerably. Let's say, for example, if you take CPO, be it a calendar spread, or if you trade FEPO against SCPO, you basically are trading in the same product. Okay, whether it's the same expiration or different expiration, essentially you are still exposing yourself to the palm oil complex. So let's say if there was a news that moved the palm oil market in a way, you could expect both to move similarly in a way. So you are actually less exposed to systemic risk in the sense of lowering risk. All right. Then obviously lower margin requirements, which Jeremy already elaborated earlier, the 70% rule. Approximately, if you did a spread in calendar CPO or FEPO versus SCPO, it's approximately 1/3 of what you would have to fork out when you're doing a outright trade. Now, a spread trade also provides interesting and relatively more ways to trade the market and profit from the market as well. Okay, I will show you some diagrams to illustrate this point in a while. And in a seasonal type trade type setup, a spread trade is tremendously advantageous in trying to take advantage of those trends. All right, and I guess most of you are familiar with directional trading. Now, essentially, you can look at spread trade as a directional bet as well. I will also explain that in a second. Just bear with me. And let me just go to the diagram. I'll tell you what I mean. All right. Now, all these good things about spread trading doesn't mean there's no upside. Certainly not. All right. In a spread trade, minimally, you're talking about 2 legs in, 2 legs out. So the commission obviously is minimally 2 times of what you would do in an outright because there are 4 legs involved, right? You long one, short one, and you have to do the reverse when you take out your position. So higher comms is one consideration. Now, the probability of slippage. When you do a spread, you have to do 1 long and 1 short. If you do it in the calendar, which actually provides, which is listed on both SCPO and FEPO, for example, you are doing it as a calendar where the exchange do the legging of the long and short for you, for example. If you want to buy the Jan-Feb spread, for example, you go in and buy a Jan-Feb calendar. Essentially, you're going long the Jan and shorting the February simultaneously, which is taken care of by the exchange itself as a calendar. All right. Now, imagine if you were doing soybean oil futures on CME against CPO futures on BMD. You would have to place an order in CME, place an order on BMD. And you could get few on one while you miss the other. So that's what it means by slippage when you're actually legging spread in that manner. All right. And another case in point is that sometimes no margin offset in certain product pair. And that would actually be quite substantial, like you are essentially taking out 2 outright position in the pair without any margin offset. Okay. And earlier we talked about correlation and co-integration. Do take note, this although holds true in the short mid-term, right? I have seen correlation and co-integration change over time, and that's actually something that you need to be wary of, especially when you turn at that point of turns, right? Because it can actually tear a spread tremendously in a way that you wouldn't expect. Okay, now earlier I talked about the ways that the spread, how we can play the spread in a sense. All right. Now, first thing first, I did explain, right? Taking a commodity calendar spread, for example, if you are buying a spread, you're buying a near month, you're selling a far month. Okay, so we call it buy spread. When you buy a spread, what will happen for you to be profitable? Well, you can see that the near month will rise, for example, if the near month rises, while the far month fall. From this point where you buy, the spread actually expands. So in the way, you'll be profiting if you actually go long here and you actually exit over here. Now, this is scenario 1. Now, when you're long again, what other way can you profit? Now, the near month rises this time, but the far month also rises. But in this case, the near month rises a lot more than the far month. In essence, as you can see, the spread expanded in terms of points. So you'll be profitable if you go long here and you actually exit this point where the spread have expanded. Okay, the next scenario in the long spread to be profitable, it can be that both months actually fall. Okay, but let's say if the back month, the short leg falls a lot more than the front month, which you're long. In essence, you look again in the diagram, the spread will have expanded. So if you have gone long here and you go take yourself out around here, you will still be profitable in this long spread setup. Okay, how about the short side, where you short a front month and you long a back month? Okay, the same scenario here. Let's say you were short here and you're long here, right? You're expecting the spread to be narrowing. Okay, in this case, if the front month fall and the back month rises, you will effectively squeeze the spread to a narrower extent. In this sense, if you were short here and you liquidate and you buy back over here, you will be profitable. And it's a narrow two of a short position if both months fall. Okay, but the front month falls a lot more than the back month. Okay, now visually it's probably not as obvious, but I apologize for that. But let's say if you're short at this point, as you can see here, that the spread had narrowed somewhat and you got up here, you will still be profitable. That's a short position. And finally, if one of the month rises, or both of the month rises, but the front month rises less than the back month. In this sense, you will see a spread came from a wider stance to a narrow stance. So you will short here and you liquidate or flatten up here, you will still be profitable. Okay, so now with that out of the way, like I said, I'd like to propose a spread type trading. Like I said, the FEPO is at its infancy. So I figured this is probably a good and conservative way for me to start, which is what I'm doing right now. And the theme of that trade strategy we are using will be mean reversion. I'll explain a little bit about liquidity and contract selection in a while, right? So mean reversion, some of you may be familiar, is basically we are trading on the premise that a certain relationship hold, which is why correlation and co-integration study comes in earlier. Now, let's say if everything were to revert to mean, no matter how it swings, so we can actually go long or short when it reach one of the either extreme, upper or lower extremes. If it hits the upper, we go short. If it hits the lower, we go long. And then we could actually liquidate or take out a position when it hits a mean or higher, for example, or vice versa. All right. The first spread I would actually introduce to you is the FEPO versus the SCPO as a spread. Like we mentioned earlier, both contracts are similar in so many ways, except for obviously the trading hours, the FEPO being earlier, and the and the lower limit in the sense and locality and physical delivery settlement for both contracts are slightly different. All right. Okay, but the commonality for both product in terms of trading hour will be from 10:30 to 12:30 and 2:30 to 1800, which is 6 p.m. Obviously, if you trade this spread, you can only do it from 10:30 where FCPO opens up. All right, and I do this spread calculation as taking FEPO price minus the FCPO price using the same expiration. Let me explain what I meant. Is like if I was doing a FEPO Gen contract, I'll be doing the opposite side in the FCPO Gen contract as well. So I match the expiration as well. So everything is identical, except it's just a different product on both sides since they have the same expiration. All right. And one point of this spread will obviously be 25 ringgit, like what you see in the normal calendar spread. Okay. Now, these are some of the data that I've drawn up using this idea. Okay. Now, basically, you can see a very tight relationship. I mean, given the narrow band between the two. All right. This is basically using a FEPO December minus the FCPO December, and then I got up this chart here. Basically, and the second chart is obviously Jan, and finally the February. Okay. It's not immediately clear here, but I just presented the as a spread point on the chart here as well. As you can see, the range are rather narrow. Now you do see some spikes like this and this, because when I started collecting this data, December was a spot month, and subsequently it moved to January. And then when it's not the spot month, right, there are liquidity concerns. So sometimes the market is not as active as we like to. So you got some outliners. So what I did was actually I used a filter to smoothen up the charts and then to make better sense of the data. Now, once I do that, you can obviously see like one minus the other and the narrow range that they actually subscribe to. Now, on this premise, it actually fits our mean reversion trade type perfectly. All right. Now, this is a bigger picture of the spread points for this Jan and February. FEPO minus FCPO. All right. So I chart it in terms of spread points. So mostly, if you can see the front months, the active one, for example, ranges from anywhere between mid-20s to mid-30s. Okay, that would actually give us a very good starting point or reference for which we will place our trade. Okay, now this is another chart, obviously, with the outright prices together as well. Let me just bring you to this same thing with the Z-score filter applied. Okay, now this is a concentration of the this Jan and Feb spread prices. Okay, the FEPO minus FCPO. I took the numbers, I took the data, and then plotted into a box chart. As you can see, the predominant range is basically between 15 to 35.5 thereabout, and that's where it occurs mostly. All right. So how would you actually trade this? Now, imagine if you're doing this December FEPO minus FCPO spread. Okay, what you can do is you can actually use a deviator, a Bollinger band, sorry, and use it to gauge, for example, what is the extreme of the upside and downside. Bollinger band at 2 standard deviation pretty much means 96% deviation from the mean in a sense. All right. So basically, when I put in this, for example, I will probably be looking to short the FEPO and go long the FCPO, hence short the spread when it hits the upper extreme of the Bollinger band, and look to rewind, or rather unwind the trade when it hits lower end of the Bollinger band. Okay. It's the same for the Jan spread as well. All right. Obviously, this is a moving target right now, but intraday trading, you can use this, pretty much use this Bollinger band as a guide for you to establish your position. Okay, so at the higher end of the range, you probably go short, and when it reverses to mean, or if it goes back to the lower end of the band, is where you get out. Okay, this is the same for the February. You can see it pretty much during active trading period intraday, for example. It behaves very well within the range. Obviously, there are certain like spikes or push to intraday and whatnot. Actually, that just presents more opportunity for ourselves. So you just need to position yourself. How would I do this? Depending on what platform you're using, I suppose. For me, because I'm using a pretty advanced trading platform, I can actually automatically let the system lick the spread for me. But the whole point is you just need to know your entry point and your exit point. For example, you'll probably be entering short here and unwinding somewhere here when it hits a mean, or if you are more adventurous, you can actually wait for it to hit the lower band before you actually get out of your short position. And vice versa, if you turn long here, you'll probably be waiting for it to revert to the mean again, or even upwards towards the upper Bollinger band before you liquidate your long. So that is the basis of operation for this particular spread. Now, based on what I've seen so far, it is actually quite doable. All right, but you just need to be patient with FEPO, obviously. It is a start, and we have great hopes that it will eventually caught on in terms of liquidity and trading participation as well. Okay, now the next spread I'm going to propose for your trade is the Dalian palm oil versus the FEPO spread. Now, this spread itself is not new. I've done it many a times with the FCPO, and it is one of the most lucrative spread to trade. Actually, if you know how to position yourself well and with patience. All right. So let me explain. Okay, Dalian palm oil. If I put the contract spec side by side, so you can have a quick look at it. Obviously, this is going to be different, and one of the reasons why FEPO started at 9 a.m. instead of 10:30 like the FCPO is actually for this market. So China is a very big market in the edible oil complex. So there's a lot of trading activities in that area as well. So when the FEPO opens at 9 and the Dalian palm oil opens at 9, so it's exactly where we can trade. Obviously, there are some overlapping of the trading hours as well. The morning session in Dalian is 9 to 11:30. That's where you can trade this spread. And beyond it, in the afternoon, you can start trading it from 14:30 to 1500. Okay, so it's about 2.5 hours in the morning, 9 to 11:30, and then from 2:30 to 3 in the afternoon. Okay, now this is a quick look at the relationship, price relationship between the two contracts. As you can see, they follow a roughly consistent pattern, the white being the olein and the blue being the palm oil. I'm using, in this case, FCPO as a gauge because I will have a lot more data for you to see and understand the logic of this trade. Okay, now the important thing to note is, like in Dalian, the contract usually actively trade in the 1st, 5th, and the 9th contract month, which usually means January, May, and September. It's habitually been the case. Just take it with, just take back with me that this is the case here. What I want to show you in this chart is like, when should you pick the January, when should you pick the May, or when should you pick the September contract to do this spread? Now, obviously, you have to have a matching expiration on your CPO side. Now, the Jan contract is most active when you turn into August. So it's approximately three and a half months before expiration is where it becomes the lead contract to trade. So right now, we are actually nearing the end of the Jan contract. By the time we hit December, the May contract would have taken over in terms of liquidity, and that's probably where I will switch. Let's say next month, if I'm trading the spread, for example, I'll be trading the May palm oil versus the May CPO. All right, you match the expiration in sense. All right, so this basically depicts the period where the Dalian side, a particular contract comes into come into becoming the active contract. All right, so this is a summary again. Like I said, most of the OI in the Dalian side is the Jan, May, and the Sep contracts, right? So basically, you want to try to match expiration as much as you can. The reason being liquidity is one, and all the trading activities of Dalian is usually focused on the spot active contract. So that means a lot of opportunity, a lot of flows, and a lot of tradability in that sense. So that's why you want to look at this, right? Okay, and this sessions, like I explained earlier, there's one further complication I forgot to mention. Dalian obviously is the Dalian palm oil contract is obviously denominated in CNY, whereas the CPO is denominated in Ringgit Malaysia, right? So you need to do a little bit of adjustment and match the price into per metric ton CNH. Okay, that's what I do here. This spread is calculated like that. I take the PAL price per metric ton, which is the palm oil price on DCE, minus the CPO price multiplied by the exchange rate to convert ringgit into CNH. So basically, we get a like for like kind of comparison between the two in per metric ton basis. Okay, now this is a quick look at the two spreads using the Jan, May, and Sep contract that I've collected. Now, they are pretty consistent if you'll just be looking at the differences here. Yes. Okay, these are collected over time, and we actually you can see a sort of like up and down, up and down, up and down recurring movement, which actually fit in our mean reversion theme again. All right. Let me sec. Okay, this is written in CNH. Okay, yeah. All right. Now, this is what I have basically summarized here based on the trade setup and the back testing. Now, why I did this is basically to fine-tune where, what period do I use for the Bollinger Band, for example? How wide a Bollinger Band do I use for this particular spread trade, for example? Now, all these numbers just means the best mix of risk and reward frequency, risk and reward size, drawdown size, for example, and it comes to approximately, all right, this chart here that we have, all right. So ideally, you will be looking at a 100 period Bollinger. Sorry, my bad. You'll be looking at anywhere like 100 period Bollinger Band, but that just describe the period of time used to draw the Bollinger Band graph, all right? Okay, this probably will relate better to you. We put up some trades there on the machine to run the back test. Okay, now it turns out that we actually have a pretty decent win rate actually. Okay, now in all, for example, out of like 71 trades in September at the point of time, which is the active one. Okay, we got 30 buy and 41 sell, which means that we have a balance buy and sell on both sides. The market is flipping, and we actually have an win ratio of about 92%. Now, that is a bit idealistic, but realistically, anything more than 75% is really attractive for us. So we have been doing this for a while now, and I'd like to tell you this is really something you ought to explore because it's really possible if you work this up here. Okay, now again, mean reversion trading in the most general sense that we explained earlier. The red dots are my short position, for example, if we were trading this. All right, this is the main contract that we previously collected. Now, as you see, this intraday movement, for example, at this higher end of the Bollinger Band, I went short, and it hits again, I went short. And as it reverts to the mean, I took it back by liquidating and turned long, and therefore short, short, long, and then basically cut over here, okay? And then basically go long again once it hit here. And some of it, there is another rule I did not explain. The length of the deviation from the Bollinger Band is another consideration, but I will not further elaborate here. But just understand the simple idea is basically we are playing the ranges, especially if the market tends to go up and down, up and down, up and down. Okay. Now, in all, for example, we have a sorry, the numbers are kind of small, so I'm straining my eyes to see. Okay. In essence, basically, we actually got something like a 70-80% win rate on this particular strategy. Okay, but obviously we have not taken into consideration the slippage because this is like the ideal situation back test. You need to do one leg in Italian and you need to do the other leg in BMD, but it's very doable. All right, especially given the crazy nature of the market in China. There is a lot of flows, a lot of teams going on at any one point of time, so that created a lot of opportunity for this spread. Okay, this is using the September month again. You're pretty much seeing the same thing. Except during the collection, this is probably the active month, which is why you see a lot more trades here, in and out here. Okay, again, the win ratio is approximately on this one, I believe is somewhere in between 70 to 80%. Yeah, they're about correct. Yep. No, actually, it's way higher. It's about 91% in this situation. All right, so something you want to think about. Okay, now how do we approach this is really when we look at it from a historical perspective, like the earlier spread, we look at the likely range to provide us a gauge of where our stop must be. Like earlier, there was one point in the chart where it actually dropped substantially. That's because of a time gap between close to open, so you can't even capture in between, right? So, but in a sense, let's say if you were short at let's say around 1700 or 1680 and the market moves against you, at which point would you take up your position and accept the loss? Well, for us, it's probably half a deviation beyond the band. Okay, that would be a starting point for you to take a look. All right, but in general sense, if you look at this, right, the majority of spread will fall within a band, meaning that most of the trade will be here, and there will be a recurring manner for this to happen, and therefore the risk reversion strategy should hold true. Okay, in summary, all right, so basically we are looking at these two contracts. You just need to do a little bit of maths here. Eventually, if you do enough of it, you obviously need to consider your currency and hedges and whatnot, right? But beyond that, you will be looking at roughly, for my setup, I'm doing 5 palm all-in against 2 CPO, just to match it pound for pound. That's like 50 tons against 2 CPO contract, which is 50 tons as well, right? And then after that, I match the value and then come up with the spread point, all right? And this is a summary of the strategy over the 3 months. And in sense, we got a number of trades about 111, right? And we got it actually on both sides as well. And the win rate of this is probably just north of 90%. Obviously, this is the ideal situation. Like I say, it's a backtest situation where we have not considered slippage. But even if I factor and price in slippage, is still a decent 75% and above. Okay, so something for you to think about and consider looking at. Now, with that, I've come to the last of my slide, and I'll hand over to Ting Ting to organize the Q&A. So please, Ting Ting, over to you.
Now, I repeat, if you would like to ask any question, please remember to send your question into this Q&A box, and please send to all co-hosts so that we can pick up your question. Please do not send your question in the chat box because we can see some of the questions being flowing in the chat box, but remember, send it in the Q&A box. Now, while you are typing the Q&A box, while you're typing your question, now this is the moment definitely some of you might be waiting for it. So we are going to have this quiz and survey form. So what you need to do is to become the winner, one of the lucky winner to win this Touch and Go e-wallet reload pin. What you need to do is the first thing, you must answer all the 3 questions provided. So the password for today is Busa. Later I'll let you know where is the link. And the second part, the survey form, you must complete the survey form. Don't worry, you don't need to rush and finish it. We will give you sufficient times for you to finish those 2 sections. Now, the cutoff time for tonight is 10:30 p.m. You must submit both quiz and also survey form. Now, second, the results will be announced within a week, but technically, for the previous session, we announced within 3 days itself. So how can you participate? You can scan this QR code, or else in the chat box, there's a link. I believe right now our admin already sent in the link. You just need to click on the link. Then the quiz, the password itself is Busa. Make sure when you key in your name, please key in your full name. So right now we are going to give you about 1.5 minutes for you to finish both before we continue with the session. Now, for those who have questions, right now you can type in the question and we are going to answer all the questions. Hopefully, we are going to answer all the questions in a short while. So please just finish within this 1.5 minutes for both quiz and also your survey form. I believe the quiz question, if just now you listen carefully, you should be able to answer all the questions. Last 1 minute. Okay, no worries. For those who cannot access, you can continue later. While we are waiting for the question, we are going to start with the first question. Now, this question, maybe Jeremy, you would like to answer. The question is, any plan to introduce mini FCPO or FEPO?
Okay. All right. Thanks, Ting Ting. Thank you for the questions, by the way. Any plan to introduce mini FCPO or FEPO? To be honest, as of now, we do not have any plan for any mini contract of FCPO or FEPO. But however, if there is any substantial request from the public itself, we don't mind to take a look into that as well. Yeah.
Okay, very good. Now, the second question, maybe for Michael. the question separated into two parts.
Sure.
So the first part is how to calculate co-integration. And second part is, can we assume all calendar months in FCPO are naturally co-integrated?
Okay, for the first question, how do you calculate co-integration? It's actually a mathematical function, and you can actually download a Excel library, right? And just collect your data, and you can run a co-integration test per se. It's a rather simple process, and there are a lot of YouTube videos teaching you how to do that. So I'm not going to elaborate. You basically just need two things, right? Say, for example, if you're using Excel, you just need an Excel library with co-integration function. Just download that, and then you collect the data, and then you run it off that particular function, and you will get a sense of the co-integration value that we were talking about earlier. Now, the second part of the question, if I understand you correctly, you meant to ask if the in between the calendar spread, if the co-integration holds true. Now, obviously, the product itself, all right, from month to month, they are correlated. That's obviously. Their co-integration, however, is not always obvious. What I meant is this: those of you guys who've been trading CPO for a while, how many times have you seen the market turn in terms of calendar term structure for this case, right? How many times have you see the term structure turn from a contango market into a backwardation like we have right now for the longest time, right? That's because of the bull rally and the tight situation in the inventory side. So that actually changes over time depending on the dynamics of the commodity itself, and it doesn't guarantee a certain co-integrated way. Now, for most intent and purpose, right? I say in the normal market with everything being rosy, you would expect that. But like I said earlier, co-integration can change over time. So yes, there is a sense of co-integration, obviously, but it can change over time given the drastic change in the dynamics that determines the price. Like in this case, for example, obviously the supply side is in a very tight spot, and which is causing the driving the prices and everything, and causing the curve to change its shape from its previous contango manner. I hope that answered your question.
Okay, very good. Now the next question, which is a good back testing platform? There are also two parts. So the first question is, which is a good back testing platform? Which you use and how often you back test?
Well, I don't physically do the back test itself. The company hires analysis help us with all this matter. But when I was doing it, for example, I was using trading technology. They have their own back test suite, and I was using Bloomberg as well for this general purpose because Bloomberg is a massive data provider, and I can get all the data of it, for example. So it's more of a convenience than anything. But in actual fact, my understanding is before I use all this platform, there are a lot of other available, some free actually, or some come at a small fee platform that allows you to do that. MetaTrader, for example, even on some of the broker hosted site, they allow you to do some form of simple back testing. It really depends on how far and complex you want to go.
Okay. The next question is for trading, which is better, breakout or mean reversion?
Okay. There is no better one over the other. You must understand why I proposed spread trading earlier. From my perspective, given the premise of what we are talking about today, right? FEPO. And I'm sure a lot of you are new to this, FEPO, myself including. So I wanted a conservative approach to trade it in a way that I can do it on a daily basis. I want it to be tradable in a way, but I don't want to put myself up there to hang to dry, for example. So this is a relatively safe approach to trade. Can you trade it outright? Of course you can. All right. If you're trading outright, obviously breakout makes a lot of sense. All right. And it does not mean that breakout makes no sense in spread trading. Like I said earlier, you could actually view a spread as an outright position, directional trade kind of thing. Say, for example, if you were studying the historical bandwidth of a particular spread that you're interested in, and it just broke on the upside or downside, for example, and it keeps running, which you would have seen actually when the market switched from contango to backwardation, you would have seen a big tear in the front month calendar spread, for example. Those are the time you can actually take on the position in the near month, for example, a near month calendar, and play a breakout sort of trade type. So those is one trade type. It really depends on what you're comfortable with. I do those as well. what I'm introducing, like I say, is more in line with what we are trying to introduce today. So there's no one better than the other. Their risk profile, their motive, their setup are all different. I hope that answers your question.
Yep. Now, the next question is more related to your ITS system. So the question is, does your ITS system have automated trading?
Okay. ITS is the name of my firm, actually. We use a variety of system. Predominantly, I use a platform called Trading Technology. There's a lot of advanced trading feature that probably is not available generally to the public. Of course, it's a subscription service. I pay an amount for it to use it. And it has a lot of feature. Well, one of it is like, for example, the algorithm that I can use and deploy and program to do certain things I want to do in a way that I want it to be done without me actively monitoring it. So that is one way to do it. Okay. So ITS basically teaches people how to use the system and how to program it, or for example, how to do a certain strategy that you want to. Let me give you an example. Say we take CPO, for example, at any one point in time, there are 24 months listed, right? 12 in front and the alternate month beyond 12. So if you were just trading purely calendar spread, there are so many combinations possible. The 1 against 2, 2 against 3, 1 against 3, 2 against 4, for example, and vice versa, and so on and so forth. Now, if you are like myself, you are trading across the whole spectrum of the market, it's not humanly possible to watch all contracts at the same time. So you need some sort of help. And that is where we teach and we show, we use the advantage of this advanced system to help us do that. Okay, we automate a lot of things. So we just need to manage the trade once we get our trade ID and trade angle corrected. So then we just basically place into the market and let the bots and the algo take care of the rest for us.
Okay, the next question, this one is for beginners. So his question is, may I know what is the recommended risk-reward ratio for beginners?
Okay, that's a good question actually. For starters, we are usually, rule of thumb, we are usually looking at least 1 to 3 return kind of thing. So meaning if the potential for you to lose $1 is possible, you should enter a trade only if you're likely or you possibly can make $3. Not even likely, but there's a possibility of you making more than $3 and risking $1. I will probably do it if it makes sense. Okay. Now, in real life, in real world, right, doing what I'm doing, a lot of times the risk reward ratio especially in popular and popular product like CPO, for example, it's very tough to achieve 1 to 3, but it really depends on how you do it and what you're doing. Okay. I do it day in, day out, for example. So a lot of times mine will just fall shy of 3. But let's say if I was trading retail, I was trading at the beginning, I'll probably look for anything beyond 1 to 3 kind of return.
Okay, the next question is for Jeremy. So his question is, when the night trading of FCPO will commence?
The night trading, when the night trading is launched, okay, then the FCPO trading hours is going to be 9 to 11:30. Okay.
So roughly, do you all have any timeline
Regarding our
launching?
timeline. Oh, I see. So then now it's still tentatively, we are looking at 6th of December, which is, I think there's like 2 weeks from now. Why I say is tentatively is because that we are still pending for regulatory approval. So that's the reason why that we use tentatively. So, but if we manage to get any approval from the regulator, then 6th December it should be firm up already. Yep.
Okay. The next question is for Michael. Can you kindly summarize contango and backwardation with respect to front month versus forward month?
Sure. Okay, let me just explain 2 things. Just I guess you're probably asking me this because I just need to verify the terms here. Now, in commodity market, the contango market basically means an upward sloping curve. Okay, what it means is basically the far month price are higher than the front month. Now, logically, if you think about it, in most things, this should be the normal term structure. Reason why? Because the further you go away from the front, the cost of storage, the cost of insurance, and the cause of uncertainty will actually be adding on to the price of the farm-month contracts itself. So that is in the normal market. A backwardation market is when the front-month prices are higher than the back month, for example, like what we are right now. Now, this will happen in a few scenarios. Like predominantly, the case that we have right now is because of a tight supply situation. Now, whenever it comes to spot, for example, right, there is always a pressure to deliver, to settle, for example, and it raises to a point where people will just rush up and start paying up, and that will drive the farm month a lot higher or a lot further than the subsequent months, for example. In that sense, the front month will be driven to a point where it's way higher than the subsequent months in the farm back.
Okay. The next question, should I let a winning trade potentially turn into losing trade because the target profit level not reached, or exit at a break even?
Okay, I suppose the question is for me.
Yes.
Well, generally speaking, no. But really depends on your trading volume and your trading approach. Now, I would like to tell you the ideal way is like, let's say if you have set up a position and you got in the money, all right? The way to protect it is actually to, like, for example, you put a trailing stop. Basically, if the market were to recoil or retrace a certain amount, for example, you'll be stop up. So you'll be keeping a part of your profit that initially when the market went in your favor. That said, depending on the type of market you trade, if you're trading in a very narrow band, that probably isn't possible. And sometimes you just have to let the market write up itself. But generally speaking, I would try not to do worse than break even. But even if it doesn't, right, your risk management comes in here. Your stop loss and everything will still apply, even if it's from a profitable position into a losing position. Okay, let's say initially profitable for a few ticks and then it went down like 3-5 ticks against you. Now, if your stop your risk management rule says that you need to get out by a certain amount and it hits the amount you get out. Doesn't matter whether initially you were profitable or otherwise, it's irrelevant. Okay, in that way you can actually hope to I suppose what you're hoping to do is you're trying to score a bigger returns in a way. All right, so you would have to take the kind of corresponding risk. I hope that answers your question.
Okay, we're going to take the last question because of the time limitation. Now, the last question is, just now you mentioned about 1 to 3, the risk and reward ratio. So the question is, for risk reward ratio 1 to 3, may I know whether 40% of winning rate is enough in medium or long term? This is referring to FCPO outright.
40%. Hang on, let me try to make sense of this. Sorry, Ting Ting, can you repeat the part about the 40%? I didn't quite get the question. What was the question asking?
The question is, I think part of it also not quite clear as well. So we are trying to figure out the question. So the question is, for risk and reward ratio of 1 to 3, may I know whether 40% of winning rate, winning rate is enough in medium to long term?
I see. So that's really a mathematical question, right? What you have to do is you take expectation win of 40%, for example. You multiply it by 3, you get 120%, for example. Then you get 60% losing, 60% of the time losing multiplied by 1, right? So you basically get 120 minus 60. You will actually end up with a long-term expectation of 60% return. Okay, so I hope that answered the question there. I don't know if that's what you're asking me, but it seems like it.
Okay, very good. Let me continue. We are going to do a quick wrap up before we continue. Just for information, as you all know, besides today's session and also last week's session, this coming Wednesday, we are going to have this final session on how to diversify your portfolio with commodity futures. As I mentioned to you, this is between both the exchanges, CME and also BMD. They are going to bring this topic to you. So this topic is more towards beginners to intermediates. So for those who find that, like for example, today's topics is a bit advanced topic for you, you might want to join this particular session. So for registration, you can click the link in the chat box, or else you can scan this QR code. Now, beside the FEPO webinar series, as usual, we also have our Let's Learn Futures webinar series also being sponsored by Bursa Malaysia. So tomorrow we are going to have this trend trading the futures. And upcoming, we have the rest of the topic in Malay, English, and Mandarin as well. Any topics that you would like to attend, can you please scan the QR code and register accordingly? It will be the same link. Now, just now, we noticed that many of you asked some very basic question, which we did not pick up because it might not be so suitable for today's webinar session. So if you would like to know more about the basic in futures trading, upcoming, we also have online workshop. This is also sponsored by Bursa Malaysia. This will be the last session for this year itself. So for those very serious who would like to get started in futures trading, I strongly encourage you to join this online workshop. And this online workshop, we are going to cover from A until Z, meaning that until you can start to trade your first contract. So in this particular day, we are going to separate into two different topics. You can scan the code, QR code, and you can register accordingly. And the first topic is the complete guide for beginners to futures trading. And the second part, we are going to cover about how to create an effective futures trading plan. And both the session, we are going to incorporate trading simulation as well. So the session is only limited to the first 50 online attendees. We're going to open up to 150 to register. But on the day itself, we only accept the first 50 online attendees. Please register as soon as possible because we are running out of seat for this particular session. Now, just a final reminder, for those who not yet finished submitting your quiz and survey form, please remember to submit before 10:30 p.m. And for today's session, really thanks to both our speaker, Jeremy, and also Michael, for their great presentation. We are going to see you this Thursday. For those who are attending tomorrow's session, we are going to see you tomorrow as well. So stay safe and good night.
All right, good night, guys.
Good night, everyone. Thank you so much. All right.
Bye-bye.
Take care.